Since I spoke to you last week, the S&P 500 is up just shy of about 1%. We're trading at an all-time high. We're in the midst of earnings reporting season. Last week when I spoke to you, I kind of said that I expected year-on-year earnings growth for second quarter earnings. Those are the earnings that are being reported right now, to be between 6 and 8%. So far, about 15% of S&P 500 companies have reported their earnings, and they're beating on the analyst estimates more than they usually do. So if you were if I was got to revise my thoughts right now, I would say maybe 8 to 10% earnings growth. And although I don't think that by itself could explain why the S&P is up over the last week, why it's trading at an all-time high, that's clearly a good thing for markets. So it's somewhere there in the mix. Let me make a couple of observations on earnings reporting. The first thing is that it would appear that analysts have probably underestimated the impact of the weaker dollar that we're having this year on second quarter earnings. We had Coca-Cola, Pepsi, Johnson & Johnson all report. On all three of those reports, it was clear these companies were benefiting because their foreign earnings, their foreign sales, when translated back to US dollars, had benefited their bottom line. And it's also clear that the Wall Street analysts, whose job is to kind of account for those sort of things, hadn't quite gotten it correct, and there had been a greater benefit from the weaker dollar than expected. If you're like me and working here in Singapore, talking to people who are non-Americans about investing in the US, obviously the weaker dollar that we've had so far this year is a concern for investors. But this is a good illustration on how big US international companies are, to a certain degree, self-hedged. They have so much international operations, so much international earnings. When the dollar weakens, actually it's kind of good for their share price, very often at least. Okay, the other thing that I wanted to talk about earnings reporting is that on the results calls, 90% of the companies are mentioning tariffs. That's obviously the subject of the day. Why is that so important besides the fact it's in the headlines every day? Well, think of it this way. A few weeks ago, Treasury Secretary Scott Bessent said that he expected that this year total revenue for the Treasury from collecting tariffs was got to be about $300 billion. When you consider that during the first half of the year, they had only collected around $100 billion, that means we're at like a $200 billion per 6-month pace, which is a lot of money coming into the treasuries. Now, so far, we haven't seen a lot of observed import inflation in the US. Consumer inflation is kind of under control. Producer price indexes are under control. So we're not seeing those tariff costs appearing in higher prices in that way. But they have to be absorbed somewhere. And the thought is, to at least a degree, that companies are absorbing the tariff costs, and that should show up in company margins. That should be a negative for US stocks. So at least with the small subset of companies that have reported so far, like I said, only about 15% have reported so far, they haven't really been mentioning that. And the fact that they haven't been mentioning that, of course, it doesn't really prove the theory that tariffs don't matter, but at least hearing the good news so far, that has made the US, that's another positive for the US stock market. That's another reason we're at an all-time high. On the subject of big companies reporting, I should highlight that we have Alphabet, the owner of Google, reporting tonight. Alphabet trade, even though it's a strong growth company, it trades at lower than an average market multiple, lower than average market PE multiple. And that's because obviously the core of Alphabet is Google search. And Google search is becoming less important to a lot of people because when they want to find things out, instead of searching on Google, very often now people are using AI. So they're using ChatGPT, or they could be using Grok, or they could even be using Alphabet's Gemini product. But anyhow, that's not a good thing for Alphabet, so that's probably part of the reason it's trading at a discount. And the other reason, of course, is that Alphabet is in the penalty phase, or I should say the remedy phase of its antitrust trial, and there's a chance that Alphabet may get broken up. Now, it's conceivable that breakup will reveal value. Very often when like a company like Alphabet, which is sort of like a holding company, gets broken up, value is revealed. But the uncertainty of it is keeping Alphabet at a lower than usual, a lower than market multiple. And when it reports, therefore, if it does have good news, the market should react favorably because the company to begin with is not expensively priced. Last week, the other thing that I said could be a catalyst for higher stock prices is lower treasury yields. And that certainly has happened over the last week. When I speak to you last week, the 10-year yield was yielding about 4.5%. Today it's down to about 4.35%. A lot of the hubbub in the fixed income market is related to the fact that Donald Trump really doesn't like Fed Chair Jay Powell, and he believes Fed Chair Jay Powell is making a big mistake by not lowering interest rates right now. If you look at where Trump's coming from, Trump just passed his big, beautiful budget. According to the Congressional Budget Office, the impact of that budget is it adds about $3.4 trillion over the next 10 years to the U.S. debt, meaning if they hadn't passed the budget and just carried on with spending the way they were before, the deficit or the total debt at the end of 10 years from now would be $3.4 trillion lower. However, that's just Trump's budget, and apart from that budget is all that revenue coming in from tariffs. Now, I had just stated about how much revenue that's likely to come in for the second half of this year from tariffs. I don't know if that's going to continue for the next 10 years, but it's probably pretty reasonable to believe that the U.S. government is going to have a huge amount of tariff revenue coming up, maybe enough to balance out the additional deficit created or debt created from Trump's big budget. The swing factor, of course, is financing the U.S. debt. If interest rates are higher, that becomes more expensive. Interest rates are lower, it's less expensive. So if Trump doesn't want to say that he made the U.S. Deficit worse, he wants lower interest rates. And of course, Fed Chair Jerome Powell is holding off on cutting rates, and Trump feels like, okay, that's working against him. However, I don't think Trump will wind up firing Jerome Powell because the Fed actually can only influence short-term rates. So if you replace Powell, who seems to be kind of fighting inflation and being very hawkish, and you replace him with someone else who's more eager or to cut rates, the impact actually on longer-term treasuries, you could see those yields go up. So it could be counterproductive for Trump. So I think he's just got to have to grin and bear it and survive with Trump until Trump will just have to grin and bear it and survive with Jay Powell until Jay Powell's term winds up, because firing him might not work towards his goal. That concludes my talk for this week, and I'll talk to you again next week.